Have you ever felt like investing is this exclusive club you're not invited to? Like it's some complex game played only by people in fancy suits on Wall Street? Well, I'm here to tell you that's not true. Today, we're going to pull back the curtain and talk about how investing really works. In plain English, without any of the confusing jargon. And trust me, by the end of this video, you'll realize that not only can you do it, but you absolutely should. So, what is investing at its core? It's simply making your money work for you. Instead of just letting your cash sit in a savings account, where it barely grows and might even lose value to inflation, you put it into assets that have the potential to grow over time. Think of it like planting a seed. You don't just stare at the seed, right? You plant it in good soil, give it water and sunlight, and watch it grow into a tree. Investing is planting your money so it can grow into a bigger financial tree. The most common way people invest is in the stock market. When you buy a stock, you're not just buying a random digital ticket. You are buying a tiny piece of ownership in a real company. Let's say you love Apple products. You can actually buy a share of Apple stock. If Apple continues to do well, create amazing new products, and make a profit, the value of your share is likely to go up. You become a part owner, and you share in the company's success. It's that simple. You're betting on the future success of businesses you believe in. But maybe you're thinking, okay, that sounds cool, but picking individual stocks feels risky. What if I pick the wrong one? And that's a completely valid concern. That's where something called diversification comes in. The old saying, don't put all your eggs in one basket, is the golden rule of investing. Instead of betting everything on one single company, you can spread your money across many different companies, and even across different industries. This is where index funds and ETFs, or exchange-traded funds, become your best friends. Imagine you could buy a single thing. That instantly gives you a tiny slice of the 500 largest companies in the U.S. That's essentially what an S&P 500 index fund does. With one purchase, you're invested in Apple, Microsoft, Amazon, Google, and hundreds of other giants. If one company has a bad quarter, it's balanced out by the hundreds of others that are doing well. This is the simplest, most effective way for most people to start investing. It's low cost, it's diversified, and it has historically provided solid returns over the long term. You're not trying to beat the market, you're simply becoming the market. Now, let's talk about the single most powerful force in investing, compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. In your first year, you invest some money and it earns a return. Let's say you earn 10%. The next year, you don't just earn a return on your original investment. You earn a return on your original investment plus the profit you made last year. Your money starts making money, and then the money your money made starts making its own money. Let me give you an example. If you invest $100 and get a 10% return, you have $110. Next year, you earn 10% on $110, not just the original 100. So you earn $11, and now you have 121. It might not sound like much at first, but over decades, this effect snowballs into massive growth. This is why the best time to start investing was yesterday, and the second best time is right now. The longer your money has to compound, the more powerful this effect becomes. A 25-year-old who starts investing a few $100s a month can easily end up with a multi-million-dollar portfolio by retirement, often surpassing someone who started in their late 30s but invested much larger amounts. Time is your greatest ally. But what about the scary part? The market crashes. We've all seen the headlines, the charts dripping in red ink, people panicking. It's true, the market goes up and down. This is called volatility, and it's a normal part of the process. In the short term, the market can be completely unpredictable. It can be swayed by news, by fear, by anything really. But here is the secret the most successful investors understand. They don't focus on the short term. They play the long game. Historically, despite all the wars, recessions, and crises, the overall trend of the stock market has always been upwards. Why? Because as a whole, humanity innovates. Companies create value, economies grow, and populations expand. When the market drops, it's scary, but long-term investors see it as a sale. They see it as an opportunity to buy those same great companies at a discount. The key is to not panic sell. Your portfolio value is just a number on a screen until you sell. If you believe in the long-term growth of the economy and you're invested in a diversified fund, the best course of action during a downturn is often to do nothing, or even better, to keep investing your regular amount. This strategy is called dollar cost averaging. Dollar cost averaging sounds fancy, but it just means investing a fixed amount of money at regular intervals. Say to $100 every month, no matter what the market is doing. When the market is high, your $200 buys fewer shares. When the market is low, that same $200 buys more shares. Over time, this averages out your purchase price and reduces the risk of investing a large lump sum right before a market dip. It removes emotion from the equation and turns market volatility into an advantage. It's an automated, disciplined approach that works wonders over the long run. So let's recap the real secret to how investing works. It's not about timing the market or finding the next hot stock. It's about a simple, repeatable process. First, you decide to make your money work for you instead of letting it sleep. Second, you embrace diversification, likely through low-cost index funds or ETFs, to spread out your risk. Third, you harness the incredible power of compound interest by starting as early as you can and staying invested. And fourth, you remain disciplined, using strategies like dollar cost averaging to tune out the short-term noise and stay focused on the long-term growth. Investing isn't about getting rich quick. It's about building wealth steadily and methodically over time. It's the most proven path to financial independence, allowing you to build a future where you are not solely relying on a paycheck. It's about giving your future self the gift of financial freedom. The tools to get started have never been more accessible. With modern brokerage apps, you can open an account in minutes and start investing with as little as $1. The barrier to entry is gone. The only thing standing between you and a wealthier future is taking that first step. Don't let fear or a feeling of not knowing enough hold you back. You now know the fundamental principles that have built fortunes for generations. Start small, stay consistent, and think long-term. That is how investing really works. It's a marathon, not a sprint. And it's a race that almost anyone can win if they just start running. Thank you so much for watching. If this video helped demystify investing for you, please give it a thumbs up and consider subscribing for more content that makes finance simple. I'll see you in the next one.